Macully, how are you
We're
doing?
back, Jeremy.
We're back.
Good.
Welcome to another episode of Money Curious, which is just a fancy way of saying you and I are going to talk about some things that one of us knows more about than the other. Today, we're going to talk about credit scores and credit reporting. You and I had a conversation a couple of weeks ago where we talked about the importance of bank data in underwriting decisioning. And this felt like a natural next conversation for us. I have mentioned to you a number of times that I monitor my credit score quite actively, and I like to ask people whether they also monitor their credit score and whether they're also as confused as I am. So why don't we just start very bare bones? And again, reminder for folks, like the lens here is always the Canadian market, because of course you and I are both based here and want to see the advancement of digital financial services in this country well beyond where we are today. What is credit scoring? What is credit bureau data? Where did this come from?
I'll actually start by asking you. So, when you ask that question on who monitors theirs, just curious, anecdotally, what percentage do you find people actually answer that they do check it?
I would guess it's around 50 to 60% of
Hmm.
people. Now, the audience is biased because it's most likely folks that are, in and around my age and in relatively similar income brackets. And I know that there is data to support that, at least that I've seen, that folks lower on the credit spectrum are more likely to monitor their credit score. I mean, that's very anecdotal, though.
Yeah, no, for sure. And I know the question's kind of a leading one, but it's interesting because, going back to, I guess it was the middle of the 2000 teens. I remember Super Bowl ads, right? And it was US Super Bowl ads for like freecreditscore.com. And it was just like everybody seemed to be getting super fired up about, free credit scores, and it became this big thing in the US. And it was around that time that, I started building fintech products and actually started again in the lending space. But there's certainly a point in time in like the lending ecosystem where it was one of the only attributes to actually base a customer's ability to repay a loan. Now, as we talked about, a few weeks ago in the bank data one, there's a whole bunch of other types of attributes and criteria to be able to pull into the mix. But your credit score and credit bureau still remains a super important piece of that pie. Back when we initially launched it, we were the first actually company to launch a free credit score in a mobile app in Canada, which we're pretty proud of.
And this was
It
Mogo
was, yeah,
for yeah.
yeah, yeah, and so back then, it's funny. The data was something around the similar. It was like 40% or 50% of customers don't know their credit score, and we were surprised by that because I mean, when we asked the same question, we would be lucky to get like 5% at that point in time. And then, even further, it was more of a question of like, have you ever checked it? It definitely wasn't anybody checking it with, any type of frequency. Because the bureaus at that point, they did allow you to check your score for free, but it was like once a year and you had to send in some, printed out forms and wait and, you get it back. And if there's an issue, I mean, at that point in time, if there's ever an issue, it was going to be a real struggle for you to go through the paperwork of getting things changed. And so the way that it came about for me and the customers that I was serving, not so dissimilar now, is that we would be underwriting customers for loans. And the top response for anybody who was rejected or declined was, why? And, that's a question that I think customers had gone years with just like or decades with just a basic response of like, I'm sorry, we just can't lend to you right now. You don't meet our minimum criteria. It's like, well, what's the criteria? Right. And it was really a black box for all consumers. But then I think, all of a sudden you start to see this trend towards pointing towards like this credit score, whether that was the reason or wasn't the reason for somebody getting declined, at least there's something measurable that if you could provide back to a customer, it was something that would help tell at least part of the story, if not the whole thing. In some instances, for customers with scores that were below a minimum cutoff range for a certain type of lending product, and so I really started looking at this score as something that we would be able to provide extra value to our customers if we were able to provide. And after all, like, we were paying for it. Part of our adjudication strategy was to pull, soft check on a bureau, and then if a customer got a loan, turn that into a hard check. But it was like, well, we're already paying for this. Why can we not put this in front of customers and like help them kind of like fill in part of their financial understanding about themselves? So anyway, we started doing that and started providing customers their score. Additionally, as a value add, but very quickly we saw that it had this bigger opportunity to really start as a lead gen funnel for the rest of our consumer products. And the way that we thought about it was really something that, and it's kind of funny because it goes back to you as a consumer. I won't call you like a regular consumer, but a fintech consumer asking others about their adoption and use and understanding of their score. We really thought that it was this product that had this potential to be something that was more social. After all, it wasn't like your balance sheet, your personal balance sheet. It was an indicator to us.
That's really interesting.
That's your really score, and we were thinking of like leaderboards, and could I add 5 friends? And I mean, I did this for a long time. I actually created a little chat group with my buddies, and on the first of every month, when Mogo dropped our new score, everybody, boom, like clockwork, screenshots would go out. Here's our new score, and we were like competing. For most, I would say that we really learned that it was more personal than that. And finances are kind of still a taboo subject, and people don't love to talk about them or share personal information of their score. We started talking about credit scores yesterday, and hey, let's record a session on credit score. What did I do? Screen share immediately. Pulled up every place that I had a credit score and showed you a glimpse into my life.
By the way, and they were different. You
Yes.
showed me 3 different scores, and I think all 3 times they were different. And this is one of the reasons I wanted to have the conversation, is just as a consumer, as somebody who buys financial services and is now monitoring their credit score, I think it's quite fascinating that the score can be different across different venues, and certainly that's due to there being different underlying providers of those scores. So I'd like you to maybe list who those people are, but also as my score changes, it is very difficult to discern.
Yeah. So I mean, I'll go through some of that. I think starting at it, it's like, look at this as more of a long-term trend line in terms of your score. It's weird. Sometimes you think you do things that have sharp increases or decreases, but I'm not so sure that that's actually what's going on. It could have been something from a few months ago that's all of a sudden taking form or taking shape. And so in my history of tracking my score and our customers tracking their scores for well over a decade now, I really started to realize that I don't think things are necessarily as like real time or kind of instant as like our brains like to think they are in the world that we live in, based on everything.
Or is correlated, maybe, right?
Yeah,
like ultimately the correlation between my action, today and the score may not be as obvious as you would think.
I just think that something that you do today will impact your score, depending on what it is, but it might actually not show up until like months from now. And it's just because you've created a new data point that is within a rule set that is like pretty like fluid in terms of like there's new data being added to a rule set all the time. And you might hit a certain point where there's an accumulation of data in that rule set to trigger a rule that changes things, but it probably wasn't the last thing that you did. It could be a collection of several things that you did leading up to that point. But back to kind of like the core part of the question is that I almost look at it as though there's some external factors that impact this complexity around. There's different scores, different types of scores. Depending on where you go, you'll see a different score. I'll talk about that. Then there's the actual internal factors. So things that we as a consumer control, that's like within the actual scoring kind of like formula or matrix that, they're generally talked about principles. I don't think I'm going to blow anybody's brains out here on this one, but it's just things to kind of like hopefully simply speak about in ways that everybody can understand and ensure that they're not missing it. And then the next one is probably one that trips the most people up. And again, let's call it 30 to 40% of your score is based on your utilization ratio. So out of all the credit that has been issued to you or is available to you, how much are you using? Generally, it's like if you're using more than 70%, you're dramatically going to hurt your score. You're going to see that impact. And, you can sort of game this a little bit, just in terms of, I guess if you're like super maniacal about it, but, let's say that you've got a credit card, that credit card provider, they're going to report to the bureau generally one time a month. And if you actually are looking at your full credit report, you might be able to start, and you're checking it regularly, you might actually be able to time and see, oh, they typically report it in the third week of the month. And so maybe if I go over 70% in the second week or the first week, you're fine. But, I would just generally say, try to stay away from that 70% mark. The place where you really want to be though is less than 35%. So use less than 35% of your credit at any given time, and you're going to see the most positive impact to your credit score. I mean, that's a hard thing to do. It depends on which line of business you're in, but like if you're an entrepreneur, as an example, and you're using some, especially small businesses, hard to get, corporate cards and stuff like that, or it has been in the past. There's a chance you're using personal cards, you're investing, you're making things happen. It's tough to keep things under 35%, especially if you're living paycheck to paycheck like the majority of Canadians. But that's where you're going to see that 30% of that utilization ratio really impact your
This is a really, really good point, that using a personal card for business expenses, that gets lost in that conversation. Oftentimes that conversation is about separating those transactions so that it's easier to bookkeep.
Yeah.
But a big part of that conversation is you would presume that a business is going to have spending needs beyond the individual.
Yeah.
And if the individual has a certain credit limit on their card and is using that card for business expenses, they're going to blow past that 35%, and it might impact their credit score. Just really quickly, the players in this market, Equifax TransUnion, is there one more in Canada?
I mean, there sort of is. Really, when you look at, which ones to follow, and really what you should be thinking about, or what's important, is what lenders are using the bureaus, like the scores from the bureaus, to make their decision. And the only two in Canada that you should really be concerned about is Equifax and TransUnion. So that's all that matters. But what I would definitely recommend is that you should be tracking and monitoring both. So, to me, it's like there's great free players in the space. There's, Credit Karma and Borrowell. If you're tracking through them, you've got the full coverage. In recent years, the banks have launched a number of, free credit score products. They might be a little bit hard to find in your banking app, but they are there. They don't seem to update as frequently as Borrowell or Credit Karma, but that data is there as well. But those are scores that are typically the consumer reportable scores. So not to add too much nuance here, but like in Equifax's case, it's like the ERS2 score, and so that's like the score that is indicative of or good enough for like a customer to look at and track the progress of over a period of time. Unfortunately, there's a chance that when a lender makes an inquiry to the bureau, depending on who that lender is, what product they're looking for, they actually might get a different score. And so this is where some of the complexities come in around, well, mortgage broker told me my score was this, but my score in the app is showing me that. Like, what's the difference? And the reality is that there is a variety of different scores. And
So just to pause there.
yeah,
So pay your bills on time.
that kind of
Don't
stuff.
use
Yeah,
100% of the credit that is allocated to you.
yeah,
Don't use 0% of the credit that is allocated to
yeah.
you. Don't
So
open and close accounts at high velocity,
yeah, yeah.
things
So
like
let's
that.
let's let's start there. Yeah. So I mean, it's generally believed that somewhere between like 30 and 40% of your score is based on literally just not missing payments. And if you miss a payment, there's very little that you can do to kind of like make up for that type of decrease in a short period of time. So it's really costly in terms of, making sure that you make your payments on time for the minimum amounts being critical. I personally believe that in the effort to simplify, the journey towards like financial health, it's like focus on what's available to you. Do all of the things you can to promote a healthy score, which includes things like not missing payments, utilization ratio. Keeping the others that we didn't cover was like keeping your credit lines open for long time periods. Like the average age of your credit product that's out there is also important. It's less important. It's probably about 15% of your scores. Minimizing inquiries, about 10% of your scores. If you're going to get a mortgage, try to do those inquiries within a 2-week period. The bureau actually count them as like one inquiry. And then don't go
I
into
just had that
collections.
experience, by the way. I
Did
had to
you?
learn that. And that's,
Yeah.
again, part of the reason why I keep
There you
bringing this
go.
up with you, because I keep finding these little nuances that I'm curious about.
Yeah.
Do you want to finish that point? Because
Yeah, I was just
I
gonna say,
did.
and like don't go into collections. That's going to impact you as well. Even like parking tickets, like through municipalities and stuff like that. You don't necessarily think they do, or some of them do. So I guess where I was going on the whole like score front is that there's some complexity behind the scene that I think adds to the confusion that consumers often come across. But at the end of the day, the good thing about the credit score model that when you get your free credit scores elsewhere is that it's not changing a lot. The matrix and the formula, like it is something that you can track over time, and at least it's one value. So say what you will about like the bureaus and how transparent this all is, at least it's consistent.
Well, it almost feels like it doesn't need to be any more transparent insofar as we can simplify the way that consumers think about this with the tools that we have today and the information we have today. So, for example, you've said that my score should be thought of as a trend line, and it's just about making sure that over the long haul it goes in the right direction. It going up 7 points and then down 10 points next month and then down another 3 and then up 20, we shouldn't be thinking as consumers too much about that. We should be thinking about, have I made my payments on time? And am I overextended on using the credit that has been made available to me? Which, if I translate that to the lender's side or the underwriter's side, is really just an expression of, can this person be responsible with their use of credit? If they have had revolving credit card or a line of credit or a home equity line open for a long period of time, my credit card I've had open for probably 22 years, the fact that I have not missed a payment and the fact that I have not defaulted in any way
Yeah.
gives lenders reason to believe that I'm not going to default in the future. And then I guess the decision for them is really about, and this is the nuance between the score that I see as a consumer and the data that the lender is going to use to make the underwriting decision. It really becomes about how much credit. Oh, this person, I can lend to this person, I can trust this person based on their past behavior. The question is like, how much can I lend to them without breaking the camel's back, if you will? Or has anything changed in this person's life that would indicate that they're actually going to use credit differently than they have in the past, and therefore this underwriting decision needs to be a little bit more considered?
Yeah.
Is that a fair way to tie the two together, like what the consumer sees and what the underwriter or the lender actually is doing behind the scenes?
Yeah, for sure. And I think the point being is that from the bureau, underwriters can see a bunch of stuff. They can see some employment data. They can see obviously levels of existing indebtedness, like aside from just the score, right? So they can use that to start looking at debt service ratios and a whole different varieties of attributes that goes into an underwriting decision. So it's definitely not just the score. I want to be really, really clear on that. But I mean, what we've seen, of course, is just over time, other sources of data being used to enhance decision-making capabilities. And there's some like intricacies that I think come up when you think about that. So especially when it comes to like bank data, I'm going to actually come back to that one for a moment.
Of course you are.
And I was kind of thinking about it, and kind of the value of keeping a lot of your like spending and consumer finance behavior within a single place, a single account, can actually become really, really important in an ability for an underwriter to make a decision on you. So, if you're somebody who's got multiple bank accounts, maybe multiple types of income going into different accounts, and all of a sudden you're trying to get a loan, and like, let's say you're linking your bank account, there's very few experiences that I've seen that go deeper than like linking one bank account. And if that one bank account paired with your credit bureau that's got all these other attributes, like doesn't tell the whole story about you, or maybe the account that you're using is not even linkable. I mean, there's some fintechs out there that currently today don't, surprisingly, you'd think they would be the ones that would, but they don't open up their card programs or their accounts to actually be able to have the data aggregated. And if you've got some spending over there, my point being is that the lenders actually, struggle to get that full picture of who you are and, your cash flow and your spending behaviors. So, I mean, it's just something for us to kind of think of as consumers in this new digital age, where, I think that accounts are becoming easier and easier to open. Cards are becoming easier and easier to get kind of adjudicated for, in some ways because we have a lot more data. But if you're not being a little bit more mindful around kind of like where all that spending behavior is, yeah, you do run the risk that a lender might not be able to get the full picture from you unless they start to take some manual means. And as you know, most of the market is trying to go to automated means. And so only like mortgage brokers and other types of like commercial loan officers take the time to go through all the details to get things done. Automated decision making might overlook some of your spending and behavior.
I'm just gonna, because this happened the last two times we spoke on the record, I'm just gonna call out that open banking solves this. Like this is another like, oh yeah, open banking solves that. Which you and I don't talk about open banking, for a bunch of reasons. But so maybe we just turn our attention for a few minutes as we wrap up here to back to the consumer and what the opportunity is that still exists in this space. It feels like there hasn't been a lot of innovation around the credit score consumption experience, right? You referenced Borrowell before, you'd referenced Mogo. I mean, Borrowell's been providing this as a service to customers forever, both as a good service to the customer, but also as a sort of edge them into their ecosystem and potentially create offers for them. Where do we go from here? Like, should I be monitoring my credit score? Could my providers be doing a better job helping me interpret it? Is that interpretation actually abstracting more of it away, or is it going a little bit deeper and giving me more specific information? Like, where do we go from here as a user experience?
Yeah, so like I always get a little nervous when you reach a point where there's a product that's widely available in the market and you kind of start to hypothesize on ways that you can go deeper and get more detailed. Because I just kind of feel like it's already, the product's already out there and it's in the hands of everybody. I think it's the flip side that's needed. I think that there's still a large opportunity to gamify the credit score experience and make it more emotionally exciting, perhaps even competitive, as we talk about Canadians becoming, more productive and, maybe a little bit less shy and, kind of trying to grow this economy and improve our individual health as we improve the financial health of our overall, of the country overall. But yeah, I mean, I think that my point being is that what we've seen is there's been an era of providing score. To me, that's kind of like past. So providing score is kind of table stakes at this point. But then we saw the traditional products that have actually been around for a long time being launched beside a score to help a customer improve a score. So these are like, some like traditional secured loan type products where it's like, hey, put up some collateral, we will give you a loan, you'll make some payments, and you can help build your score. I'm not saying that those don't work. Some of them do. They can be slow, but they also it's really dependent on what else is going on in the customer's financial life. My point being is that loan alone isn't necessarily going to dramatically change anything if some of the other aspects of the formula aren't being addressed right at the same time. So I think that there's probably a new wave of products to be launched alongside your credit score, which needs to be there, that I just think are like more emotionally driven products that are less functional, but they still provide function, but most of all, like value to keeping a customer on a streak, showcasing all of the key behaviors that we know impact a score over the long run, educating them. It's almost like the stock market, right? In the last 44 years, like there's like an average of like 5 dips over 10% in the S&P 500 per year. Point being is that like get comfortable with the risks that there's going to be some downturns in your score, but that over the long run, should you continue to like streak through the behavior of kind of good behavior, then you're going to get to a point where your score is going in the right direction, and lenders are like looking at your bureau profile positively.
That is such a great point, and it's a great way to end it too. It's also a jumping off point for a future discussion about what data is getting reported and how are we opening up the bureaus for more types of data to be reported, like rent data. I'm sure if we had like Lisa on from Chexi,
Yep.
we could have a very interesting conversation. We could probably, bring in somebody from Equifax or TransUnion to have a broader conversation about what data is being reported, what isn't being reported today, and how that is impacting the usefulness of the score, and maybe whether that is creating a gap between the utility of the score for traditional lenders versus new types of lending products like BNPL. My understanding is that BNPL does not get reported, and so if you're taking point of sale buy now pay later loans, those are not getting reported, and for some that's probably good, for some that's not so good, and for everybody though it means that the full picture is not available in that bureau data and reflected in that score. And I think maybe that's an interesting follow-on conversation over the next couple of weeks.
Yeah, no, I love it. I mean, there's definitely lenders that are users of bureau data that aren't reporters of bureau data. And I think that there's like, that's part those lenders, but it's also part the bureaus. From what I understand, there is a push, and the bureaus are working towards a new reporting model for alternative lending types, which I think would include everything from cash advances to BNPLs, shorter term loans, just like alternative like lending asset classes that I think should be represented. Because a lot of the consumers that leverage those products, not all, but a lot of them, are the ones that would benefit most from actually building and improving their credit bureau and their credit score. And so, the fact that they've existed in the shadows for so long, I think is doing those users in our country a disservice, because we need to help pull those that are using these products up into better products. And as it stands right now, the credit score is not going anywhere from an underwriting perspective.
Damn, well said. I didn't want to say anything as we were talking, but I did hear your kids in the background. So they are not fully engaged in Free Willy 3, which I didn't know existed. I
Yeah,
stopped at
no,
Free
I
Willy
was
2.
I was saying, like, things are tough when you get to Free Willy 3, right? And then when things are like really tough, and I searched it, there is a Free Willy 4 as well. So I mean, depending on how the rest of the day goes, I'll let you know how Free Willy 4 turned out.
I'm almost waiting, like I'm kind of stretching this out right now, waiting for one of the kids to just like bust into the frame with a bag of ketchup chips all over their face, and let's cut it there, and you can go and share the chips with the kids.
Awesome. Okay. Thanks,
All right,
Joe.
brother.
Have a good one.
See you soon. Bye.